Good morning, good afternoon, and good evening, depending on where you may be in the world. My name is Sophia Arend, and I'm the Global Blockchain Business Council's Communications and Content Lead. It's my pleasure to welcome you today to the GBBC's Virtual Members Forum. This is a bi-weekly webinar we host showcasing the innovative work of our members around the world. And today we are joined by Thomas Chladek, Head of Asset Management, and Shane Edwards, Head of Investment Products at Diginex, for a presentation and audience Q&A on the performance and pitfalls of crypto hedge funds. So Diginex has been building its crypto asset management expertise over the last 4 years, taking decades-long experience in traditional asset management and applying it to the unique opportunity of this space. Diginex has built a range of solutions to access these opportunities, from Delta One listed safe and efficient vehicles to sophisticated hedge fund-like portfolios. In fact, Diginex's flagship liquid alpha-centric fund of crypto hedge funds recorded a rolling annual return of over 130% to April 2021, generating impressive returns, including during periods of weaker crypto prices. We'll hear more about that today, and we'd like you to note that today's event is for educational purposes only. Shane and Thomas will share their journey and lessons learned in the space and illustrate the different solutions investors can consider when looking at the crypto ecosystem to implement or augment their traditional portfolios. Just briefly before we begin, I'd like to provide some background on today's presenters. As I mentioned, Shane Edwards is Head of Investment Products at Diginex, and prior to joining Diginex, Mr. Edwards was Managing Director at UBS Investment Bank, where he held various senior roles, including Global Head of Solutions and Structuring and Global Head of Equity Derivatives. Thomas is Head of Asset Management at Diginex, based in Lausanne, where he is responsible for managing digital asset investment strategies. Prior to joining Diginex, he was head of Alternative Solutions Group at Lombardier-Odier, where he ran hedge fund selection and fund of hedge funds management globally. Prior to this, he worked at Calibria Financial Services and in investment management as a hedge fund allocator. So to all of you who have joined us live, we welcome your questions at any point during today's presentation. You can submit them in the Q&A box at the bottom of your Zoom screen, and we'll take them throughout the presentation and afterwards. So thank you so much, Thomas and Shane, for joining us. I'll hand things over to you.
Terrific. Thanks for joining us today. These sure are interesting times we're experiencing in crypto. So I hope we can share some of our experience and some of our insight and shine a light on a few things. As was just mentioned, Thomas and I are from the Diginex group, the first NASDAQ-listed crypto company. We're very proud to say, and we have a number of different divisions within the group that I'm going to touch on briefly before we get really deep into the fund and our approach broadly to how we allocate and look at the different types of strategies that exist in crypto. The Diginex group, the heartbeat of the company is Equos, which is our crypto exchange based out of Singapore and growing at a fantastic rate. Access is our business rolled out to institutional clients seeking a unique access solution to get exposure to the different crypto markets through one convenient portal that we've developed. DigiVault is our UK FCA regulated digital asset custodian, and this is certainly a growing area as more institutions are adopting crypto and having to look for a solutions provider like DigiVault as they make that big leap forward. And today we're here to talk about Bletchley Park, which is the asset management part of the group and broadly fits into our investment products offering, where we're also going to be rolling out a range of innovative solutions so that clients can get exposure to digital assets and to crypto in a range of different formats and a range of different specifications, depending on the unique exposures that they are seeking. Next slide, Thomas. This is briefly about us. I guess we've already heard that bit. Suffice to say, a lot of the Diginex team have long histories in the traditional finance markets and asset management. We've taken that experience over to crypto and digital asset finance as we seek regulation and transparency within our business and try to operate to the highest standards, inspiring institutional confidence and greater adoption in the asset class is our mission. Okay, so this is where it starts getting really interesting. Thomas, let's flip forward one more. Now, people are presumably very familiar with hedge funds. They've obviously been running for a long time in the equity markets, bonds, FX, and macro trading. But as everybody is aware, those markets are increasingly complicated and competitive as more and more computing power and smart people mine out all of the remaining alpha left in those different markets. So increased efficiency of public markets impacted managers' ability to achieve returns in excess of market gains. Once upon a time, life wasn't too hard for hedge fund managers, but throw in a bunch of supercomputers, lots of PhD graduates, and there's not a lot of alpha left on the table. There's also very large inflows from passive allocators distorting valuations. So that money, the money that follows trackers, the money that comes into ETFs, it takes its exposure on a formulaic basis. So there's potential for large and persistent distortions away from value as the passive assets swell in volume compared to active management, the ability to go and bring that alpha back to perhaps what is a more fair level. It's tough in hedge fund land. Look, the chart here, we show the exponential growth in the S&P as there's been a lot of money printing in the world. People have come into equity searching for those kind of returns. And it's been tough for hedge fund managers facing a wall of money coming and looking for a home. So what does the crypto industry have to offer? Well, it has some room to go in terms of all of the alpha being extracted. The industry itself is nascent, the asset class is nascent, and there's significant structural inefficiencies that have long since been taken advantage of in the traditional financial markets. Amongst other things, the highly fragmented markets. In contrast to stocks, the market actually trades 24/7. As people probably aware, we've recently seen some large moves on Sundays. So they say crypto never sleeps. There's a variety of different data sources in the market. There's often no golden source, so people really need to keep their finger on the pulse to understand what's going on. The ecosystem of products that continues to get more complicated. People are presumably aware the market has since evolved from spot trading. There's futures and a range of other instruments, perpetual contracts, etc. And there's a range of strategies that can seek alpha at looking at discrepancies in the valuations between those different products, even though they're trading the same underlyings ultimately. There's also a huge amount of retail volume. So that's something hedge funds often like to interact with as they try to gauge the sentiment of money coming in and out of the market from speculators. There's improving risk procedures, but they're often unsophisticated. So there's times when the market starts falling, there's anecdotes that stop loss gets hit, and that kind of sometimes creates a momentum or serial correlation effect. And maybe there's some hedge funds out there that look for those type of momentum trades and earn alpha that way. There's certainly a lot of evolution in the regulatory landscape as the product moves, and price discovery is forever moving forward and making a lot of progress. So there's plenty going on in the crypto world. That's absolutely for sure. But I think really the key point is that a huge amount of the competition that exists, keeping the stock market, bond market, the FX markets efficient, is really only just now starting to find its way into crypto. And there's still some very unique alpha opportunities that you probably don't find in other asset classes. The crypto markets are certainly evolving. It's very hard to pick up a newspaper or even drive past a bus stop in London these days without seeing an advertisement for Bitcoin. So it's getting a lot of people's attention. The chart in the bottom left shows how volumes have been consistently escalating in the industry. We show futures volumes, which have come a huge way since they first started out, spot volumes as well as options volumes. We're really starting to see the potential for derivatives in the crypto market. That's something that's going to continue for a long time. On the right, we talk about 8,500 different cryptocurrencies, which might be mind-boggling, but it certainly shows that there's a jungle out there to go and search for alpha opportunities and relative value trades. It's not just Bitcoin, it's not just Ethereum, even though the newspapers obviously love those stories. There's deep and liquid derivatives markets, topping 50 billion of daily volume with regular spikes above 100 billion, particularly in recent times as people jump in. And in fact, the futures volume can be multiples of the spot market, which is not unusual because for a long time that's been seen in interest rate markets, in FX markets, and the future of crypto could very, very well show extreme volumes in derivatives markets compared to underlying spot. That's not unusual at all, but it certainly does create trading opportunities between the different ways of accessing the underlying markets. This slide talks briefly about the increasing institutional adoption for the segment. As I said, it's rare you can pick up a newspaper these days without hearing something about Bitcoin. But for a while, institutions were a little skeptical of the space, but I think we've seen a steady and consistent adoption of digital assets. Banks that once didn't quite know how to position it have now been almost forced to start responding to client demand, and they're having to have a product proposition, whether it's for passive exposure to Bitcoin, or whether we start seeing more headlines for people saying actually they want active exposure because they recognize that there's unique alpha, and they're consistently being requested by clients, how do we get exposure to this? Banks therefore have the dilemma, do we ignore that business and perhaps it goes elsewhere, Or do we try and embrace it, recognize there's an opportunity, and how do we responsibly position a product that could meet client demand whilst upholding the kind of standards you'd expect from an asset manager or a bank with regards to governance, regulation, and transparency? So there's certainly a number of different interesting opportunities out there. There's growing demand, and there's probably a record ever number of questions with people saying, how do I get exposure to crypto? My friends have got some, I want some, but I hear it's volatile. Am I too late? Should I wait for a dip? I wish I had the answer to all of these questions. I don't have a crystal ball, but it's a bit like the stock market. It's notoriously difficult to time, but of course in a stock market, most people allocate their money to fund managers with a view that experts might have insight into how to do some of those things. Experts might be able to find opportunistic transactions and ways of making money that perhaps regular people can't. And of course, there's an opportunity like that in the crypto markets. In the crypto markets, it's interesting to learn that there's actually hundreds and hundreds of crypto fund managers out there. So again, there's a jungle of managers, but there's considerable room for expertise for finding those managers, analyzing those managers, making sure they've got strong governance standards and real opportunities for building returns for clients. Thomas, let's flick forward. And I guess now we're going to hand over to you to really get stuck into Bletchley Park Asset Management.
Yeah, well, thanks very much for setting kind of the background of what the really kind of the opportunity is today for hedge fund managers. Maybe I think kind of backtracking, giving a bit of the journey that led us to today from a product perspective, but also from what we've designed and built as an asset manager. I think I remember the early days when I had discussion with Richard Byworth, our CEO, back in early 2018, really kind of scratching the surface of this new asset class. And it's very rare to see a new asset class. I think many of us haven't seen any before this one, and really kind of starting to think about what would be the best way to approach it. So as Shane mentioned, there are different ways you could get exposure. You could be a long-term believer and try to get beta or delta 1 exposure. But you could also try to benefit from the action that takes place in this space, which we've seen over the last few days, and obviously very often are reminded that volatility and up and downs of this market are very frequent. So with our background being asset management, investment banking, and hedge fund allocation, we really started to think about what would be the best kind of risk reward, we thought, in a liquid format. And for us, it was evident that looking at all these elements that Shane mentioned before, this will be one of the best opportunity for experienced and talented hedge fund managers, i.e. traders, to come and seek for that kind of alpha that is currently at offer. The thing that I would add is that you're currently probably at a very unique inflection point where at the same time we have a lot of opportunities that are there, they're deep, they're liquid, and also you have growing adoption. I mean, obviously there is no day without Bitcoin being mentioned or cryptos being mentioned in the press for good or bad reasons. But what we know for sure is that the adoption is just growing with serious players entering the market. So while potentially this space was untouchable 3 or 4 years ago for traditional investors, today you have ways to get exposed and to go and seek for that alpha. So I think it's very important to understand what we're trying to design. And as many things that we do at Diginex, we really try to port expertise and knowledge that we've each kind of developed over the last 20 plus years in traditional finance and see how they could be applied to this new asset class, or to these new kind of different venues. And if I look at what we've been doing on the hedge fund selection side, the job is exactly the same. From a standpoint of you want to do an extensive research, you want to go and find out as many managers as you can. And we go into the details of how many we think there are out there. But to give you a lead, there's probably between 800 to 900 managers that we've come across. But the work is always the same. You go and you search people, you try to find specific characteristics of their strategies that make sense from an allocation perspective. The second element when you're running a portfolio, obviously it's risk diversification. So if everybody is doing the same thing, the only thing you can do is dilute your risk by kind of spreading your chip across a few players. But actually, when you figure out that there are different strategies that have different mechanisms, and we can illustrate that with what happened in May, for instance, you actually have another element of diversification, which is actually allocating to strategies that inherently are not behaving the same. So some strategies are benefiting from the volatility, some strategies are benefiting from the spreads. And so what we've thought was that this space would offer this. And after years of research since 2018, we really kind of come up with strong arguments that actually you can build up a robust portfolio allocating to different hedge fund strategies into crypto land. And those are kind of defined by three big buckets: liquidity provision, trading, and fundamental. They all have specific characteristics that allow portfolio construction to work and actually offer you as ultimately potentially an allocator a very robust exposure to that opportunity. The other element that reported are very, I would say institutional, which is very risk-centric in the approach. It's not about betting like all the chips on a specific token or a specific manager. Everything we do is really kind of risk-based and risk-centric. So ultimately, what we've designed is a product, and obviously we're not here to pitch specifically a product, but I think the product illustrates the fact that you can actually approach this space as a truly unique source of alpha, a very robust way to get exposure to this. Just a few words maybe on the space. For many people, I mean, the funds or the hedge fund space within crypto is just a few big brands out there, and then a bunch of very small shops. But actually, there is a vast variety of managers, of structures, of setup that exist out there. We've come up with a list of more than 950 funds today. When I'm saying funds, it might be funds, prop shops, any type of structures. And actually, our job is really kind of to drill down into the quality list of managers we can then potentially allocate to. But going through that process allows you really to get into the nitty-gritty of the different strategies and the different managers. But I think it's very important for people on this webcast to realize that ecosystem is growing immensely, and you see more and more even traditional kind of big brands starting to look at the space. So I think that's also kind of a proof of resilience of the space and opportunity that is out there. Maybe spending just a few minutes on the different sub-strategies that we've identified in the space, so that people realize that it's not just one big trade that is out there. Obviously, the obvious trade is to buy Bitcoin, to stay long Bitcoin for a long-term view. But as you can imagine, when the market can go down in a couple of percent in a few hours, and currently in a drawdown of probably 35% or 40% over the last few days, we feel that there is also plenty of room for active strategies. And so the way we look at the space is across these three buckets that you see here. Liquidity provision are people that are actually trying to go after what we call spreads. So basically mispricing that might be micro structures of markets, so futures versus spots, for instance. But in a nutshell, people need to understand that these were strategies that were bread and butter for most of the investment bank and the big hedge funds back in the late 80s, early 90s. And the only place where you can really do this today in a deep liquid format is actually cryptos. And the opportunities are plentiful. The other pillar, which is the second pillar of this slide, is what we call trading. Ultimately, what you need as a trader to benefit from a market is volatility and liquidity. Well, if you look at Bitcoin as a proxy of the whole ecosystem, it is clearly volatile and it is very liquid, as people who have been trading Bitcoin have probably realized. So I think it creates a lot of opportunities as well for active trading in this space. The last bucket, which is obviously coming with more market flavor, i.e. beta and volatility, is fundamental. And what you've seen is, even though it's still early, it's still in its infancy, there is real kind of potential for what we would call stock picking in a traditional kind of equity market, i.e. for tokens to be actually valued based on their merits rather than just to move all as in one big block. And what we see is that it is evolving quickly. You start to see the correlation between the good and the bad projects. Obviously, there are periods of high volatility where everything moves as a big block, but over the medium to long run, we're strong believer that actually stock picking will make a difference in this space as well. So as a portfolio manager, as a fund of fund, you have three buckets that have different characteristics. To give you a sense, for instance, liquidity provision in trading is probably flat to slightly up in May, while fundamental, because of its exposure to the market, is obviously down. And so if you combine these blocks according to different techniques, you actually can create a very robust solution for yourself, which can actually access this alpha. Just a quick illustration of the process. Without going into too much details, I think the idea is that you can apply the exact same process. It will look very similar to processes that have been applied by some of the largest fund of fund or hedge fund allocator out there in the traditional space. So sourcing is the same as I mentioned. You can create like different committees and boards, which we have, and being part of a group such as Diginex allows us to have that integrated process and oversight function. And ultimately, you can create those different solutions for yourself. Quick words on the numbers. I think really more for an illustration perspective. Obviously, May is still not being printed, but we expect May to be probably down 1% as we speak right now, versus a market that is down 35%. And again, this is purely done by allocating to existing managers that are out there and constructing robust portfolios. So I think there is a clear potential, not only for crypto-focused allocators, which might be on this call or maybe not, but clearly exist, but also for traditional kind of players. That was clearly our background, Shane and mine, and most of the people within Diginex. And you see that you can replicate some of these very attractive strategies in the space. So kind of to recap, what you can do for your traditional portfolio outside of a Bitcoin allocation, which might be a very good way to decorrelate, to protect against inflation and different kind of general macro topics, you can actually go and try to find yourself a new source of alpha. As Shane mentioned, I mean, alpha from liquid hedge funds has been very thin, to say the least, over the years. And actually this space offers you a complete new playground. However, with proven techniques, robust processes, and ultimately what we've seen since we launched the product, which is basically live numbers, are proven results. So I think that's really what we wanted to discuss. And I think Shane might have a few words to close it down.
That's well said, Thomas. Look, it's a unique space with unique opportunity to access alpha. It's a complex space as well. I think a lot of people get excited about all the different types of altcoins out there, and trying to become a pseudo expert in any of that really is very complicated. I suppose it's similar to the stock market, where people try to become pseudo experts in thousands of stocks. But as history has shown us, there's an opportunity for managers in the crypto space really to find value in a lot of the different altcoins, and even run spread positions between the different altcoins, look at how they correlate to each other to build different kinds of strategies. So we're often asked, hey, buying Bitcoin is a great investment. I can make tons of money, and that's fantastic. We hope people manage to achieve that, but it's also volatile, and there's different kind of alpha that can exist. I think for us, some of the most exciting aspects are the fact that you can make a positive return in a diversified crypto fund potentially, and being able to do so in practice, even when Bitcoin is down for the month, because Bitcoin is the flagship. Bitcoin is the one that grabs the newspaper headlines. But there's so much action in a range of different other altcoins, and even in a range of different arbitrage strategies around Bitcoin. And this just isn't alpha that retail investors are probably going to be able to find on their own. And that's, suggests that really managers can still add a lot of value in this space, because the competition just is not at the level that you see in the stock market, where there's so many people with so many fast computers having mined all of that alpha out of there over decades and decades. This still looks like a fantastically fertile and interesting opportunity. So, Thomas, do we want to run through any more things, or do we?
I see a few questions on the Q&A. So there's a few that we want to try to answer. If I can pick one in terms of kind of priority, I think there's an interesting one related to the discussion about the different strategies that we see, and I'm going to summarize it up. Where basically the question is, do we see hedge funds or funds out there that are blending kind of, and actually like the term fast and slow money together, i.e. kind of trading, market making with VC type of approach? And so the answer to that is yes, we see some of these guys that are doing it. But the second answer to that is that we don't like it, because ultimately these are very different mechanisms, and in most cases, very extremely different skill sets. I'm not saying that you can be a good VC investor when you're a market maker, but in reality, most of the time, if you're a good market maker, you've done this for 15, 20 years plus. And if you're a good VC investor or allocator, you've probably done the same for that number of years. So ultimately from a experience point of view, in general, we tend to go for pure plays. There is also another element, which is about how you structure these type of fund vehicle. And if you look at market making, extremely liquid, right? I mean, a market maker book can be liquidated in a matter of a few seconds. A VC book obviously is not liquid. So how do you treat your investors and what terms you offer will be extremely demanding and challenging, to say the least. And having been running different structures and been allocating hedge fund money back in the late 2000s during the global financial crisis, you saw what liquidity mismatches basically had as an impact on the overall industry, but on your portfolios as well. So this is something that is extremely central to approach and to any due diligence really on the fund. So I'd say, yes, it exists. It's not necessarily a bad thing, but for us, it's typically a tricky one, and we'll go for pure solutions.
I might grab the next one then, Thomas. There's a good one here about derivatives. How do you expect derivative products to attract more risk-averse investors to gain exposure to crypto? It's a great question because the derivatives marketplace we forecast to grow very substantially in crypto. And when a lot of people think of derivatives, they think of leverage and they think of speculation. But actually, one of the main reasons for the creation of a derivatives market in the first place was really about risk management. So to take an obvious example, people, when the market moves forward, people should be able to buy put options to protect downside exposure to crypto portfolios, just like they buy put options on the stock market to protect the downside beyond a certain level. Similarly with call options, they're the fundamental building block to building capital protected notes and things like that so that risk averse investors can get exposure to the crypto market. So we see a developing and healthy derivatives market actually as very important so that investors can get different types of risk exposure within crypto. And that's something we're very excited about in the future.
I see one about our average kind of holding period of positions, which I'll just take. So basically we are, a fund of fund in general should, I think, be long-term holders. We do, and Ashane can has seen it. We typically spend months before investing, pulling the trigger on any hedge funds that we allocate to. So in general, if we stay for a short period of time, is that something happened, something obviously negative happened. And so we're long-term holders of this position. That said, many of the positions we have in the portfolio are extremely high turnover and extremely active traders. So again, it's very active from a risk exposure to the market, to the trading activity, but we are long-term holders. We're building relationship with these managers that we allocate to.
There's a few different questions in there about the custody solution. Perhaps people grabbed the DigiVault line that I mentioned. Look, we're extremely proud of our custody solution. It's built to be institutional grade, and we see a very growing business appetite as institutions come into the digital asset field. Within the hedge fund, the different managers we allocate to, we really look at them purely on the basis of alpha. And then, of course, we think about how we formulate the portfolio overall. So the different strategies are complementary and that we keep the volatilities and return robustness to the right levels. The managers are free to trade on different exchanges, use different custodians. Our role really into the due diligence is just understanding the robustness of their processes. There's hundreds of crypto hedge funds out there. They range from small to big. They range from well-governed to not well-governed. So part of the due diligence we do is understanding the quality of their processes and procedures and making them fit for purpose.
Yeah. Few questions on DeFi, which is obviously a very hot topic. So to be very clear, we're not very exposed to DeFi. We have some, I don't want to say residual, but kind of side exposure, maybe via some fundamental strategies that I mentioned. We might have positive kind of views on some of these projects out there. So that would be a Delta 1 exposure to the projects itself. We have some trading and arbitrage strategies that have marginal exposure to some of these DeFi kind of lending pools, but it's generally very small because of the risk that comes with it. So if you look at the returns that have been made by the portfolio, it's been 98%, if not more, done on a more kind of plain vanilla type of arbitrage and trading without venturing too much into DeFi. Again, it's not that we don't believe there is value in there. It's just an additional layer of complexity and really kind of uncharted territories that we don't feel we necessarily need to go kind of all in into this to generate the type of numbers we have so far. So I'd say we're extremely cautious about the space. We understand that opportunities exist, and we've spent a lot of hours discussing some of these with different managers, but it's not a significant part of the portfolio in any sense.
Thomas, if I may, it'd be best if you stop sharing your slides just so your video would be prominent.
Yeah, so I think there was a few questions about the structures, regulatory landscape, and our portfolio. So just give you a general overview. So one question was about liquidity, lockups, liquidity. So a few words about the space. In general, I would say it's very similar to what hedge funds' traditional liquidity terms were. So no offense to my European friends, it's not a UCITS product, and it will probably not be for the foreseeable future. It's really kind of hedge fund-like in the traditional sense of the term, which are, basically quarterly liquidity. I would say probably 2/3 of the universe is on quarterly redemption frequency. As a result, we are quarterly as well, even though we have a monthly exit option, but that is under a specific number. So basically only 10% of the assets can go out every month. So that's to be a bit more commercial, but just to make sure that, as I mentioned, we don't want to end up in any kind of liquidity mismatch at any point of time. We do have a lockup, however, that is a soft lockup. You can get out for the first 12 months, but you have to pay a penalty. Again, this is very mainstream for hedge funds. It's just to make sure that people are not just kind of jumping in and out of the product, because it creates more complexity from an operational standpoint. It wouldn't be fair for long-term holders. The other few questions are on regulation. So obviously regulation is really very close to our heart. As a company, as an asset manager, as individuals within the firm, we all basically bring in like 20+ years of investment or asset management experience, and you need to work with regulation. So there's been a lot of things that have been about trying to create solution quickly and go for easier regulated places. The product is Cayman, which is probably where you find, again, 60 to 80% of the traditional hedge funds being regulated. The asset manager is Swiss-based, which FINMA being probably one of the best regulated out there. And most of the managers we allocate to are, I would say, within the top 5 or top 10 regulation places. There are clearly a few regulation that have tried to kind of become famous for crypto funds regulation. But in general, we end up investing in funds that are regulated by the top 5, top 10. But there's one that just came up as a fund governance structure. So it's a bit kind of along the same line. We are very plain vanilla. So we use, obviously, external administrator for independent valuation. We have annual audits of the portfolio. We have a board of directors that is, we basically have 3 directors. I am one of the directors, but the 2 other directors are completely independent. They're professional directors, very experienced people that we've dealt with for probably 15 to 20 years. So we've known them extremely well, but they've been very kind of famous directors in the Cayman Islands. So it's a very kind of straightforward institutional kind of process. In terms of internal governance, I think something that I mentioned also when we went through some of the slides, I think the thing that makes us quite unique is the fact that we have this activity within a much broader NASDAQ listed entity. So obviously for us, as a global firm, as Diginex, governance is extremely important. And so we currently operating as an investment committee, which is kind of the daily running of the portfolio, which reports directly to a supervisory board. And on that supervisory board sits our global CFO, global head of risk from an operational standpoint, global head of risk for an investment standpoint, and the head of asset management. So I think we really kind of redesign what you would expect from a very institutional asset manager when it comes to this solution, regardless of the niche where we operate in. It is a very kind of plain vanilla institutional frame process.
Thank you so much, Thomas and Shane, for running through that extensive list of questions that we've received. I think just one more question that's come up is kind of what's the breakdown of your clients? I mean, is it high net worth individuals, family offices? Do you have any insights into that you could share?
Sure. So I guess there are, I mean, so it's, first of all, it's only for qualified investors. So depending on which jurisdiction you sit in, the definition might be slightly different. And then what we have is what I would say is probably an equal split between, I'd say, high net worth, but I'll get back to that, and more institutional type of investors. And when I say institutional, it's really what we call kind of acceleration cap. So it's not about pension, but it's really kind of more investment banks. And when I say high net worth, it's what's very interesting is actually our first client base, and still a very significant one, are actually that basically qualify as high net worth. They're individuals that are extremely experienced from a trading perspective. So think CEO, CIO, head of risk of some of the largest hedge funds out there. Obviously, I'm not going to drop names, but for us, it was extremely positive to see these people who get it. I mean, they are the ones who traded these, I mean, the traditional market when they were that inefficient. And actually the pitch to these people is after we go after slide 2 or 3, they're like, okay, I get it. I don't have the time to spend what I should trying to make money the same way I did like 20 years ago. However, I trust Diginex, I trust your process. And this is my best way to get exposure to that alpha. And yeah, I mean, again, thanks for the question, but I think this to us is a very valuable type of investor because they validate this approach.
You can really see the different speed of the learning curve for different types of clients. As Thomas said, when you're talking about high net wealth and professional investors that maybe were investment bankers or hedge fund traders in the past, they recognize that this is a unique opportunity to earn alpha and they kind of grab it. Family offices are constantly looking to diversify their source of returns. So, they move from the stock market to hedge funds to private equity funds. And they're now having a very good look at this because there's not that many assets in the world that offer this level of diversification potential. And then institutions have been trying to get up to speed for some time, but mastering digital assets and crypto is quite different to some of the things they've looked at historically. So there's a longer learning curve. But as I suggested in the opening, ultimately, if client demand keeps knocking at the door of the different private banks, investment banks, and wealth management houses saying we really want something in this space, I think it's really compelling them to try and put together an offering, and that's really the trajectory that we're witnessing at the moment.
I think to that end, we just got a question. Somebody asked, what's the biggest hurdle to traditional asset managers allocating into crypto?
Well, I mean, I can tell you what it is from allocating to the fund of fund, and I think Shane can go on to allocating directly to the assets itself. I mean, for a fund of fund perspective, I think the biggest hurdle really was when we launched it 18 months ago because there was nothing there. And they had no data points. I think today, just to give you like a very interesting observation point. So when we launched, I basically tried to invest into the fund.
Oh, Thomas, you've gone on mute.
So the way you do it in Switzerland is via your bank, your custodian. And it was a straight no to invest into the product because it was crypto and because, I mean, multiple different reasons. At this stage, I think we have 10 or 12 different banks that are allowing the clients, not promoting the fund, but allowing the clients at least to buy into the product. And this is only 18 months after we launched it, and it was a straight no. So I think there is not that many hurdles to go via this type of solutions today. Then going direct, and I'll leave it to Shane to comment on this one, is obviously has evolved a lot, but it's different.
It's just the learning curve that I talked about. It's a great question. What's the biggest hurdle for traditional asset managers? I think it's the learning curve. There's such a learning process. I think for individuals to do something with their own money or family office money, they feel they're ready to take that level of responsibility. As an institution, it's one thing to get comfortable at one level, and then obviously you need to go up different layers in the hierarchy to get different people comfortable. They ask about different infrastructural requirements. Have we fully understood the due diligence? We understand that the returns potential is super attractive, but do we understand all of the different risks compared to traditional hedge funds and traditional assets? And Thomas and I and the rest of the team spent a considerable amount of time working with people in traditional finance, trying to share our experience in that regard and try to answer those sorts of questions. The good news is people really enjoy the learning process because people have typically worked in traditional finance for a very long time. And people love learning new things. And it is a truly exciting and unique asset class. So it's a great hand-holding process. It just takes a little while, but at least in my mind, it's a very clear trajectory that we're going to continue to see a lot of progress in this area. We'll take up.
Thank you. As a final question that we like to ask, I mean, you've talked about how things have changed already, but what do you expect 1 to 5 years out for the space and for Diginex and the asset management business more broadly?
I'll keep going then for a second, since Thomas on mute. For me, it's about institutional adoption. You know, I think, look, there's been a couple of U-turns recently for institutions, and that's fine. But the trajectory in my mind remains unaltered. Like, it's an incredibly exciting space. The technological revolution that's underway here just can't be ignored. I mean, it's tantamount to looking at when the stock market went from trading in the pit and people were yelling out buy and sell through to being computerized. So the underlying technology, the amount of assets that are going to get traded on digital blockchains, that's a one-way trajectory. And that changes the infrastructure that underpins the financial system. So one way or another, people are going to have to really take notice of what's going on here. And it's going to create incredible opportunities. It's a very, very exciting transformation.
Yeah, I mean, the only thing I'd say is, and it's a question we get asked very often, is how long will the opportunity for alpha stay? And I think at the same time, you see that broader adoption. And I think at the same time, you see that tremendous alpha stay for quite a significant time compared to what people would say it's only a few months. I think we have a good 3 to 5 years easy because of what Shane mentioned initially in the presentation. So I think we'll see both broader adoption, more players coming to the space, and that's how the market's going to grow and mature. And this is how we're trying to position ourselves.